Happy Friday, everybody. Welcome back to the weekly market analysis for the week ending May 26th, 2023. Just a few more trading days left of May, but by the time we come back, it will be time for June, the last month of Q2 2023. I just want to take a moment before I get started here looking at the markets, reminding you to hit the like button and subscribe to the channel. You can also find me on Twitter at, didn't have it up, Mr. J. Thomason. And then you can also subscribe to my weekly newsletter at befinanciallyfree.substack.com. And just a little note that if you do subscribe, the first half of the newsletter is absolutely free. It covers all the same content that I've been covering free for free subscribers ever since the newsletter started. But the second half is for premium subscribers, and you get a much deeper dive. You get trade ideas, which maybe I'll highlight one in this video because I want to give you a taste of the types of signals that you can get in the newsletter if you are a premium subscriber. And if you're not sure, give it a 7-day trial. We do offer those. So we'll jump right into the markets today, looking at the NASDAQ. We'll start here. Because the question that we're asking today is, will the markets ever go down? And obviously that's a little bit of a dramatic headline or a little dramatic video title, because obviously the markets are going to have corrections. Obviously the markets will have bear markets. But the reason I've said this is because if you are only looking at the NASDAQ, I mean, it's basically been almost a straight line up. And every time we've ever had something that could cause a market correction, or anytime the conditions have been primed for a market correction, something has changed the narrative. Something has caused mass buying sprees. So the NASDAQ today closing at 14,332 and 50 cents. This is the highest close that we've had since going back to April of last year in 2022, and it's been a euphoric jump the last couple of days. And honestly, if we hadn't been in a bear market in 2022, then if you had only shown me, and I'm gonna change some of the graphics here for just a second, and if you were only looking at this, you would say, oh, that's a blow off. And I'm only saying that not because of any frustration or anything. It's really interesting how context changes everything. Context changes what this looks like, because when you look at it pulling back, including the 2022 bear market, then obviously that looks like, oh, we're just coming back up. We're maybe starting a new bull market. We are recovering price action that declined all throughout 2022. But if you look at it here, I mean, it's got all the makings of a blow off top. It's got a couple of waves, a little jut up, and then a decline, and then a boom to the upside. And on a rate of change basis, this is the type of stuff that we've only ever seen coming out of the bear market bottoms. So like the COVID bottom, that when the Fed came in with QE, we saw booming price action there. Coming out of the 2009 bottom, similar kind of price action. And then obviously, honestly, this type of price action wasn't even really seen at the top of the .com bubble. But I'm not gonna sit here and try to make comparisons today. I'll leave those kinds of observations for my newsletter if you are interested. But the NASDAQ, I've been tracing for a while. I've been tracing this ascending wedge, and it finally looked like it was rolling off over the last week, and then the big news was Nvidia earnings, which were just insane on a lot of different for a lot of different reasons. But the price action that followed it and the euphoria that it feels like it has generated has pushed the markets back up to new yearly highs, and we broke out of it. And I've said before, a lot of times when you see these kinds of breakouts from ascending wedges, because usually these types of patterns, they break down most of the time, and then it's usually a waterfall to wherever the point of the second, on a technical basis, usually somewhere around the point of where the trend line connects to the second candle up. So we were playing with the possibility of a pretty significant correction if it had actually come down and broken this trend line, the lower trend line, but it actually broke out. And a lot of times that's bullish. And so what I'm watching here is a couple of things. I've got this this trend line at 14,367. We're just below that, and that actually comes back to the bottom of a little dip that came in late 2021, October 2021. And so we'll see if that holds. I had that marked a long time ago, so we'll see if it holds at all for resistance. It wasn't really much of a support. It played resistance on 2 occasions, and this is only going to be the 3rd time that this level has been tested from the underside. And so I'm going to keep the wedge here, because what you want to see is follow through or consolidation above the breakout. You don't want to see this drop back in, and so I do want to call that out. What has been interesting is ever since March, we haven't really had any point in time where the tide line has really been tested, and the tide line is pointing very, very, the steepness of the tide line is considerable, so I want to call that out. But again, I said this earlier, if you were only looking at the NASDAQ, you would think everything's hunky-dory, everything's going in a straight line, and yet the S&P, while it is, actually it didn't close at a yearly high. It's barely below its high that it just made earlier in the week, and not so high above its February high, and it hasn't gone above its August 22 high yet. And we have this wedge pattern that appears to be in place, and I don't know if you want to do it from the bottom wick there, or if you want to do it from one of these wicks here. Probably look something like that instead. Maybe I'll just keep them both just in case. But anyway, I'm watching this kind of ascending triangle wedge sort of pattern. We'll be looking to see if it breaks out to the upside here in the next week or so. But the S&P kind of in the upper area of the trading range that we've been in for something like a year. And so I just want to call that out. And then when you look at other indices like the Dow, which we had a breakdown from the wedge, but then it popped back up. So this may be a fake breakdown, and fake breakdowns are usually really, really bullish. So we'll see tide line is still on the bullish side, and so this is actually usually a pretty good spot to go long when the tide line is bullish. When tide is bullish. And so we'll see if this ends up playing out and being a good spot to long. The Dow has been lagging, and then obviously the Russell has lagged a lot. And the Russell is on the wrong side of everything. It's on the lower end of the tide line. Tide line is bearish, kind of to the low end of this big trading range that I kind of marked a while back. And I'm just have the lines there because I want to be aware of them. And so what is concerning is that the Dow, which is only 30 stocks but equal weight, is lagging, and the Russell, which is 2,000 stocks, is also lagging. And what actually you could look at here is let me see. Let me do a quick adjustment here. I apologize. I'm kind of doing this in real time here. So I like to do this. If you look at the SPY and then compare it to the RSP, which is the equal weight S&P, then you can see obviously I've showed this in my newsletter, the outperformance of the S&P, which is market cap weighted, and obviously the top 7 or 8 stocks have had the majority of the gains. In fact, if you just year to date the RSP, the equal weight, is actually slightly down year to date, while the market cap weighted SPY is, I think, up something like 10% on the year. And so obviously things have diverged considerably. And then the big news was obviously, let's see, NVIDIA So I want to show this chart, which is, if you go back, and I mean, NVIDIA is at all-time highs. This chart is pretty ridiculous, basically going from October, selling down into December. But since the beginning of the year, year to date, has just been a ridiculous chart, basically a straight line up. And then obviously up really big here. On yesterday's price action, it was up almost 25% on its earnings, which smashed all expectations, including, interestingly, they guided to the next earnings report being, I think around 2 billion. Well, I can't remember exactly the number. It was considerably higher than the estimates, and what's funny is that the market boomed on that guidance more than anything, which is very interesting to guide so near term like that. But in any case, that's what happened. And what's really interesting is if you look at the NASDAQ. Going back to the NASDAQ, this is just the normal index. It's not the futures here. What you notice is if you take out, if you take out, actually probably the best way to look at this would be if I actually, again, I'm kind of doing this in real time. I apologize. If I pull out my global liquidity layout here, and what you'll notice is, and I've been talking about this a lot on Twitter, is you kind of notice that the liquidity, or the NASDAQ decoupled from liquidity right at about April 25th. April 25th, everything changed, because you can kind of see, obviously the lines are getting a little messed up here, but you can see right about here, you can see the liquidity line, the blue line was coming down. The NASDAQ started to curl, which is the pink line, started to come down. And then April 25th, if you don't remember, April 25th after hours was Microsoft's earnings. And then the next day was, I believe, Meta. And then the day after that was Google. And with all of the AI craze that was happening, that was really where the divergence happened. And then a week later, let me go back to my NASDAQ chart. So let me find April 25th. April 25th, right here, kind of if you see where my crosshairs are. The next day, April 26th, right? So we got this big boom, and then we started to sell off. And then Thursday, after hours, was Apple's earnings. That rocketed the market up. And then just a little while later, we were already rolling over again. And then the next week, there was news about Google with its AI implementation, and that shot the markets up. And then we had another run-up relating to AI. And then we were finally, after what seemed like forever, see, I've been calling for correction since mid-April, and we were finally getting the NASDAQ to start rolling over, start to fall over. And then, of course, we had NVIDIA earnings. And then on today's price action, everything got moving. I think the news on the day was relating to potential debt ceiling negotiations, which, of course, there's a lot of talk, and then we'll see what happens over the weekend. And anyway, a lot of people chasing right here. A couple of things that I wanted to point out, going back to the liquidity chart. What's really interesting is, if you invert the liquidity, then what's really interesting is, starting in April, it's almost like the NASDAQ was tracking the inverse of liquidity, which is really interesting to point out. And that has not been the case basically ever. So I'm not saying, maybe this time is different. I don't know. But it's really interesting to note that. Another thing I want to note in the markets is the breadth. I've talked about this quite a bit. And while breadth improved on today's price action, it's worse than it was last week, which was worse than it was the week before, which was worse than it was the week before. So breadth is extremely low. And the reason I'm highlighting that is I want to just kind of show you what you find here on this chart. If you pull back, what you can look at is times where breadth was really low. Often, not always, like when breadth crosses below the 50 line, it often coincides with corrections, small corrections, or sometimes large corrections. And then what you notice is the green line. The green line has typically marked really good bottoming points after significant corrections. And so if you actually go back to the candles, just to show you the last two, breadth hit a low June 13th of 22, and also hit a low September 26th of 22. And if you go back up to just S&P futures on a weekly chart, so that I was looking at the weekly chart, the same week, same weekly chart, the same weekly chart, June 13th, the week of June 13th, was the weekly low before the big summer bounce last year. And then Monday, September 26th of 22, though it wasn't the low per se, it was a buyable low, and markets haven't really been that low since. And so I'm just calling that out because it's one way that you can kind of track when you get into corrections and bear markets and things like that. Where are those places? Basically, if it crosses below the 15 line on this chart, then that's typically a good spot to start leaning in if you're not already. So just wanted to mention that for my loyal subscribers. The dollar index, let me get my indicators back on here really quick. Again, sorry for the real-time delays. Dollar has broken up into onto the opposite side of its tide line, so we are at bearish tide, but the price action has been really strong to the upside. I'm just going to call out the bias, because the tide line is bearish. The bias says that this is a good shorting spot, and so what you might do if you're into trying this is going into next week, looking at U.S. dollar pairs and looking to see, looking to find a good level to go off of. What I'm concerned about, though, is that the dollar may go all the way up to kind of the mid 105 level, and that would actually fit sort of this trading range that we've been in for some time. It could just be this sideways range for a while, so you want to make sure that you give this some room. But anyway, you also don't want to FOMO into this. The signal for the bulls here is to wait for potentially a tide cross. So this is probably going to look something like that. So you're looking probably sometime in early to mid-June if there's going to be a potential cross in the tide line. So if you get a tide cross, just like getting a tide cross here with price coming back up towards the tide line is usually a pretty good spot. In the same way, if you can get that tide cross and get price to come up and then dip back, that would be the right spot to take long entries. But you don't want to chase this right now. If you're already in the trade, then you should be protecting yourself on the way to the upside. Another thing I want to call out here is yields. Again, just on a straight march up. I'm going to be watching as the yield gets close to 3.9, what price does here on the yield. We do have a little bit of light resistance overhead around that same spot, so there's a confluence. Let's see, there's a confluence right around here, so you want to be watching that. And to go along with that, if we just take a look at the 3-month, the 3-month is, if you follow me on Twitter, you know that I watch this for kind of real-time indications of where the Fed funds rate is going to go. And right now it's above 5.25, so I'm expecting a rate hike at the June meeting. And if you actually go to the CME Fed Watch tool, then what's really interesting to note also is that it is also now heavily pricing in high odds of a June meeting, or I'm sorry, of a June hike. And then we're almost at the point, if we go to the December 23 odds, we are now at the point where we're pricing in a much higher probability of no cuts, at least no cuts from the current Fed funds rate. So the market is basically saying now, well, we're expecting now rates to go to 525 to 550, but then by the end of the year they'll cut at least once down to 500 to 525. So that's interesting. So what you have to think about is, if you're the Fed, let me go find also the SOFR futures. That's another good way to look at it, is the SOFR futures. SOFR futures are up at 4.985, and so if this goes up and hits above 5, then that's again the market finally pricing out rate cuts versus the Fed's dot plot. Now that's what I want to talk about here, because the Fed's dot plot says that the Fed funds rate is going to be basically between these levels in December at the end of the year, and the Fed has said repeatedly that they were not going to cut. And so what we're wondering about here is either the Fed is, if the Fed is still sure that they're not going to cut, that they're going to keep rates higher for longer, then either they're not going to raise rates again at the June meeting and they're just going to keep it at that level, or what you'll see is at the June meeting you'll get the June SEP for Q2, and they'll actually change the terminal rate to maybe 5.25 to 5.50, or maybe even higher. And that's something that you have to, that the market has to consider. And so then we would have to be in the process over time of repricing these December rate probabilities even higher. And what's really interesting is the market has not believed the Fed for most of this time that they were even going to, think about, a lot of people have been saying, the bond market, they're all looking at the 2 years. Let me pull up the 2 year really quick. Everyone's watching the 2 year. The Fed's not going to hike. Honestly, the Fed, nobody thought the Fed was even going to get where they're at, right? And so, that's why watching the 3-month yield is going to be the best indicator of where policy is going to go, because by the time we got to the first hike, it was already at the right level, and it's been at the right level at every moment along the way. So I would encourage you to, put a chart of the 3-month in your watch list, just so that you can be apprised of that. But in any case, the market has largely not believed that the Fed would be as hawkish as they have been, and they look for every which way, every word to suggest dovishness from the Fed. And here we are with the Fed funds rate at 500 to 525 basis points and potentially going higher, and the market never at a single point believed that it was going to get to this point. And even as they repriced higher, the market was convinced that there was going to be cuts. And so that's going to be, that's something to think about. And all the while, look at where the S&P is at. Look at where the NASDAQ is at. You tell me if the Fed feels, that they have successfully tightened financial conditions. I don't know. Let's take a look at gold. So I'm going to highlight gold for just a minute, because in my newsletter, which was my May 14th weekly newsletter, it was in the premium section, so free subscribers didn't see this, but I'm going to share this here. So May, what did I say that was? That was May the 14th. So on May the 14th, that's a Sunday, I made a call on metals. And so the first trading day was right here on May 15th. And if you at the open had followed my trade advice, let me actually go to GLD, because I want to do this on the ETFs. If you look now, I already had these up here. Let's see here, get the right spot. If you look, gold since that trade idea is down 3.36%. All right, let's look at SLV. SLV, a little bit more shallow, 3.26%, after having been down pretty considerably. Let's go to gold miners. Oops, GDX. This one, check this one out. let's see here, is down 10%. And then the silver miners down 8%. So, you know, I'm not gonna take the time to go through all of the reasons why I made those calls, but just listening to those calls would have made you some money, and I think that that's totally well worth the $5 premium subscription. But I'll leave that up to you guys. Just my little shameless plug there for my newsletter. And while some people may say, hey, well, you know, you've been calling for correction and that didn't pan out, right? You have to remember that the whole goal here is you're trying to prevent drawdowns. You're trying to prevent your capital from being eaten away. And so while I've been calling for correction, you know, that's one of those things where the best option is to hedge. Hedge your positions or de-risk in some way, so that you can try to avoid those drawdowns. But when you make a call like this, I pretty much said that you could short anything related to the precious metals and you'd probably make money, and that's what's basically happened. So I'm just calling that out. Now, silver is oversold, and gold has also come down to this ascending trend line. So that'll be interesting to watch. If we break this trend line, then I actually see us falling to the mid 1800s. And I am, because of the tide line, I am actually looking for price to come down below the tide line. It usually does, but that could be just below 1900. So kind of a range that I'll be looking for on the price of gold, somewhere, let me put this kind of a box here, somewhere in this range I'm looking for gold to fall down between. And some of you may have seen, I have a pretty strong conviction that we're not going to get an all-time high above 2075 in 2023. We'll see if that prediction pans out correctly, but right now I don't see that happening. I see that as a 2024 event, not a 2023 event. But of course, everybody wants that stuff to happen right now. Bitcoin recovering a little bit, but not looking so hot on its price action. Price for Bitcoin closes in about 55 minutes from the time of this recording right now. So we'll be looking to see if this closes back above its tide line. Usually when tide is bullish, it's not as good a buying position, but buying when price is between the tide and control line is pretty good. But you should always be aware that when price does make these corrections, they can come down below the tide line. And so I'm actually looking for price to come down to around the 24,000 level before the best buy entry probably comes into play. So we'll see what happens on that call here. Now, conditions. Are the conditions still favoring correction? And I think just the mere fact that breadth is low, and in fact we're about to get a tide cross on a bearish tide cross on the breadth indicator here. The stock's above the 200-day moving average, and anytime we've had a cross when price was already below the 50 line, it was not good. So like this one was in March 2020. Obviously, you know how that turned out. This cross was in October 2018. Let's see, we didn't get it. The cross was already here. We did get a 15% correction back then. 2011 got a 15 or 17% correction there. So bearish cross here in 2008. We all know what happened there. So just calling that stuff out. Breadth is not good. The liquidity situation, unless you believe that that liquidity is no longer going to be a driver of markets, then this is still a concern that you want to be prepared for. Definitely, if you're not buying protection up here, it's like after all the gains, if you're already long, buying the protection here, like it's a no-brainer. You got to do it. Because the downside risk of reversal could potentially be really big. And there's risk because if the debt ceiling is not actually, if there's not actually a deal to raise the debt ceiling, then markets could come off on Monday. And honestly, looking at NVIDIA, this price action, whoops, that's actually, I shouldn't have done that. Let me go back to this chart. This type of price action is not sustainable. Let me take one more look here at a couple of things, show you my side-by-side chart here. If you just look at NVIDIA, massively oversold on the RSIs, both on the daily and the weekly. Huge movement in the MACD histogram, overbought on the on the stochastics, both daily and weekly. It's just it's not sustainable. It could stay up here a little bit, but I'm expecting it's going to correct at some point. Even if it continues to go up, even if we go up to 450 or 500, I've seen price targets for 500 now on NVIDIA. But even if we were to get up there, like it's not sustainable. It's to go in a straight line like this. It's going to pull back. So you do want to be prepared for that, and just be careful about where you're buying. And then further, if we look at the Qs, we are back in overbought on the RSI on the daily after coming out of it for a minute. We are now at overbought on the weekly RSI, overbought on the weekly and daily stochastics, and then going to XLK. And I'm highlighting the tech-related ETFs because I want you to be prepared for the fact that these 8 stocks that are in these different ETFs, they've been the ones driving the market. And so if they come off and correct, it's probably because of where breadth is at, it's probably going to cause a pretty significant market correction. So XLK also overbought on the RSI daily and weekly, and on the stochastics daily and weekly. And then I wanted to look also at, oh my goodness, it's not coming to me off the top of my head. Can't remember, but basically all these different ETFs that you look at are showing you massively overbought. Things can stay overbought for some time, but it's getting a little bit too stretched for my liking. And so it's, again, you don't want to chase. And probably the biggest lesson that I would say from this is to understand what you're seeing here is that there are people like you and I, maybe if you're like me and you're on the sidelines, not riding this wave. So obviously I'm missing it, and obviously that hurts to miss a big rally. However, the worst thing that you could do is FOMO into it, where you don't have a place to risk manage, and I think that's what you're seeing. That's why this has the risk of being a blow-off, because you've got everyone and their mom rushing into this because everyone is like, I can't miss the gains, I can't miss the gains. And it's those kinds of circumstances where corrections happen. So just want to call that out. And then finally, wanted to take a quick look at the PCE data, which kind of shows that consumers on a year-over-year basis are doing seemingly okay, but the rate of change has gotten worse, and so that's something that we want to call out. So 3-month annualized, that means a year from now on the 3-month compounding rate of change basis doesn't look so hot, but still, if you look at real disposable personal income, it's still forecasting a year from now to be at around the pre-COVID level. Same on nominal employee compensation. It's mostly the personal savings rate and the real personal income ex transfer that is a little bit concerning, although the rate of change on real personal income ex transfer is coming back up. And then what's really interesting too is to notice that real PCE, real goods PCE, real services PCE, all considerably down on a rate of change basis. That's the red bar. And then the year-over-year, below the pre-COVID trend on real PCE and real goods, but still a little bit higher on real services. And so this actually shows you that we're probably actually, and maybe this sounds like a no-brainer to some of you, we're probably actually deflating now. But the problem is that the favored inflation gauges are still well above pre-COVID trends and well above the 2% inflation target. And the big one is core PCE. Core PCE they want at 2%, and it's double on a 3-month annualized basis. and on a year-over-year basis is at 4.7%, which was actually higher than last month's reading on the year-over-year basis. And so the problem is the Fed is looking at these indicators when this is more of the reality right now. And so because of that, it's entirely likely that what's going to happen is, let me get back to my charts here. What's probably going to happen is because of these numbers, here we go. The Fed is probably going to hike again, and who knows, maybe they'll hike again in July if things don't improve. But we largely haven't seen really the effects of the rate hikes on the real economy. Well, we haven't really seen them in the data that matters the most to the Fed. And so the Fed is probably going to, they probably already have over-tightened, and they're probably going to over-tighten even more. And because of the fact of those metrics that I was just showing you being so lagging and still well above their trend, I don't see a situation this year where they're going to, when they start to see the stress in the economy, I don't see them changing direction. I don't see them cutting when they should. And so I think that the markets should be concerned about that. But obviously, as I said, AI and the stocks that are benefiting from the AI narrative are booming. And so, yeah, it's kind of a hard market. Can't really say any more about that. That's it for the weekly wrap. Thank you for tuning in if you've tuned in this long. I'll see you guys next time.